Hello and welcome to the paid weekly recap for the week ending June 13th, 2025. I'm Keith Harwood, CIO of Yellow Tunnel, and also pictured as Vlad Karpel, the CEO and founder of Yellow Tunnel and the creator of the artificial intelligence behind the predictive AI for dynamic markets trading system. Before we get into the weekly recap, normal disclosures, options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself are not investment advisors and not registered with the SEC nor FINRA. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, myself and/or the team at Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. If you need a few more moments with the disclosures, please go ahead and pause the video here. Otherwise, we will get into the recap for the week. First things first, we've got the 10-year yield. 10-year yield has been fairly range bound here, really setting up 4.3 up to about 4.5 with an occasional spike. We spiked to 4.6 a few weeks ago. We have not really retested the low end of the range around 4.1. The stability of the 10-year yield is actually fairly important to me for the market because it helps reduce one of those potential inputs that could drive a big bearish reaction. The bearish reaction I'm worried about is frankly driven by a situation with low economic growth and high inflation. We're not seeing high inflation numbers, and we're not actually seeing low economic growth numbers, generally speaking. Pretty good non-farm payrolls, pretty good inflation numbers. All this is helping keep the interest rate level fairly stable and show signs that we don't have to worry too much about that stagflation concern. And that's a spot where the Fed can't lower rates in spite of a weak economy because we have inflation, and they feel like they can't raise rates to fight inflation because of a weak economy. Kind of stuck with not being able to do anything. And while we're basically projecting them to do nothing for a few more months until they do maybe start to lower interest rates as the futures market is basically predicting, at the end of the day, what we're seeing right now, no major shifts in 10-year yield. And I think that's a generally good input for the market. However, we have a negative input for the market that's not hitting US bond markets or 10-year yield. And that is the growing, escalating tensions, battles between Israel and Iran. So this week, things started to look like we were getting bored. Being bored is okay for the bull because a lack of bearish news or a lack of bullish news generally means the market can drift higher and there's more stock selectivity. But things being okay is good enough for a bull market because there's usually positive investment flow into the market. Investment money has to go somewhere, and oftentimes it's just into the market. 401ks, pension funds, etc. Got to put their money somewhere. And lacking bearish inputs, the market can continue higher. We had progress with the US-China trade negotiations. Markets go a little bit higher. But then this growing tension and the attacks between Israel and Iran puts a new bearish input for the market, something else to focus on. Merely a week ago wasn't really a concern. It was a little bit of maybe a background noise, and then it became the forefront focus. Crude oil spiked. Gold ran up a little bit, and the markets took a pullback as people shifted out of risky assets. So the S&P 500 had a rough Friday, but we still held some main support levels. Around 595, 596 was the May 19th high. We closed at 597. Will we continue to hold that support level? We shall see. But for now, it's a dip. Getting below that level, the next key support level is around 575. 575 was the March 25th high, and really the level that we retested here in mid to late May. So ultimately, that's about 4% down, 3 to 4% down. That's a decent sized dip if I ignore some of the crazy volatility that we had back in April. And then if that doesn't hold, then we start to get into more panic mode. So right now I'm looking to see how this market can behave after the dip to the first support level into the early part of this week. If we have de-escalation between Israel and Iran, I wouldn't be surprised to see us push towards those new highs around 613. And if we have escalation, it would not be shocking at all to see us push down a little lower. Individual sectors will perform well in that scenario from an investment perspective. So, war can actually be good for certain stocks. Lockheed Martin, Raytheon, the energy sector right now is showing some positive signs as a result of the higher oil prices. So for whatever your belief is on the war or the battle itself, from an investment standpoint, there are certain sectors that do benefit from this kind of tension. Tech has not actually tested the previous high quite as aggressively. It is holding up pretty well, but it is also dipping here. So we need to see if that can hold support, and then the next support level for tech for QQQ is around 490. We're very close to that support level here as well. But similarly, we get a little dip. We've got some little risk off or profit taking or hedging type behavior going into this market right now. And then small caps. Small caps just can't seem to get a leadership position in this market. Last couple of days, we started seeing pullbacks, and then Friday was a bigger pullback. Didn't hold the previous high from mid-May. That didn't hold. Real support now looks like the March 12th-ish low. We're looking around 5% lower for main support. Let's just call it 200 for IWM for a rough ballpark. Small caps just don't seem to want to be the bull leader. Rejected the 200-day moving average, now pulling back, continuing to lag the broad market bullishness for the long haul. And the VIX, speaking of hedging behavior for the market, the VIX did spike up around 21% on the close on Friday. We also saw some aggressive buyers of out-of-the-money puts, indicating that people are looking for the tail risk protection here. So it's not buying puts so that they can buy the dip. It seems like we're getting life insurance, buying the tail risk scenario just because we don't want to go through what we went through at the beginning of April again. If things get much worse, then how low can the market go? Rather than finding out after the fact how low the market can go, people are hedging just in case it happens. And they may be buying stocks and buying puts, so a protected put position. Either way, it's insurance, it's creating a stop embedded in the market, and that is inflating volatility on the whole as people flock towards these insurance bets on further out of the money puts. Now, that does often reduce the potential risk of, return of options trades for the bull case. Because if we have a traditional size move to the upside, but we're pricing in this potential higher percentage move because of concerns over the downside, it does potentially reduce the magnitude of the return on the upside if we do go back to a bullish trend. But with the dip, we have a few dollars of movement or a few percent of movement just to get back to the high, and that broadly offsets the elevated VIX here. So overall, the paid trade that we are going to be seeing this week, one more new one this week, does still have generally good leveraged opportunity here, positive risk reward profile. Everything else looks like it's lining up well. I will note, though, that for this week, Honeywell just never really got moving. So after Tuesday having a dip, we tried to liquidate on Wednesday, unfortunately, and then bounced back okay and held up relatively okay. But just generally speaking, Honeywell didn't hold up great. GE, sort of a similar stock, really kind of took a dive this week, a lot of profit taking there after a nice long bull run. And that's what it seems like we got this week in Honeywell as well, with some profit taking after a long bullish run. Not as severe as some other stocks with profit taking, but nonetheless, the 3-day return in the stock was down 1.2%. And because of how cheap these options are, that actually can lead to a larger percentage loss, because 1.2% for Honeywell is actually a pretty good size move on an implied expected move basis. So 1.2% is a significant move for Honeywell. And as a result, we did see a 37.5% loss on the option. But we'll move on to the next trade for next week, and I'd see it as a bit of a higher volatility stock coming up. I don't want to ruin the surprise, but watch your inbox. Tuesday morning, we'll have at least one trade. I expect it'll probably be just the one, but we're looking at least one trade. I'll confirm all the numbers tomorrow to make sure that everything is looking good before sending out the alert, and make sure you got the look on your inbox there. And as always, make sure you're joining us on the live trading room. A lot of good ideas coming out, a lot of quick action conversation points, what looks good, what doesn't look good, what could generate the next leveraged return, or one of the safe haven type trades that could be profitable in a market with a new potentially bearish input. The track record speaks for itself. Vlad and I are always there for the morning and the closing bell, or almost always, barring an unforeseen issue that causes, or a scheduled issue that causes us to be unavailable. But from 9:15 till 10:30 Eastern in the morning, from 3 to 4 in the afternoon, we're happy to answer any questions about any stock you're looking at, see what AI is predicting for that stock, and then looking at some of the option structures that we could put together for a positive expected value trade. And as always, if you want to give us reach out to us via email, I'm available, Keith@yellowtunnel.com. Vlad is Vlad@yellowtunnel.com. We're happy to answer any questions via email. If you can't make it onto the chat, that's the best way to reach us. So never hesitate to reach out and let us know if you have anything you want to discuss. Thanks again, everybody, for being valued members of Paid, and looking forward to a exciting week in this market. Thanks again.